Swing trading and day trading. Which one to choose? Hey guys, what's up? Welcome to our YouTube channel. Today we'll be looking at swing trading and day trading. Which one to choose? Day trading. Day trading is a source of income. It pays the mortgage and car payments, and all of that is true, but wealth creation is even more so. And don't get me wrong, I'm all for saving for retirement and the like. It's not that they have to be that way all the time. You can certainly make money swing trading, for example, but the scalability factor in swing trading is one of the reasons you can make so much money with it. And we'll go through it in this video. Swing trading. Swing trading is a type of trading that lasts for a longer period of time. You're holding a stock for 1 day, 2 months, 3 months, and so on. Intraday trading, on the other hand, is often in and out of deals in 5 minutes, 20 minutes, or an hour. However, the concept or the reason for doing them is a little different. Day trading, income producing, swing trading, wealth producing are huge investments. I believe there are a lot of people out there that feel the same way and believe there is something utterly unique. Swing trading and day trading are fundamentally different. Intraday trading is a type of trading that takes place within a single day, and you'll find out today there isn't much difference between them. Swing traders versus day traders. Day traders seek to profit from short-term movements. It's not as easy as that. You're looking to make a deal from 9:30 a.m. to 10:30 a.m. and 9:30 a.m. to 4 p.m. The majority of day traders do not trade all day, but some do. If you enjoy having sweaty palms, this is the place to be and be exhausted at the end of the day. The first 2 hours of the day are when most of the money is made. You can earn money during such time, but it will be more difficult. If you're a day trader, you'll probably be in a trade for at least 5 minutes and possibly up to 2 or 3 hours. You're usually in a trade for less than 30 minutes, and that's a fact. Over half of your business is in 30 minutes. You'll be out of there, and assume that you're trading for 1, 2, and 5 minute time windows. It could be longer if you're trading a 15-minute chart. Intraday traders, on the other hand, are primarily aiming for short-term gains to keep a profit while the stock rises. That is, if you want to make money earlier, but you're also hesitant to return too much of that money. Guys, it's usually a money-making event. You want to pay your bills and your mortgage, have that car you want, whatever it takes, and feel the kids. It's a money-making event as if it were a normal job. Day traders operate in this manner. Swing traders, on the other hand, are those who trade in small increments, are going to have to be more patient by nature. Why, you ask? Because these deals, by their very nature, take a long time to materialize, let alone hit a goal. So your end says 1 to 15 days, but I'm just going to adjust it to 1 to 90 days. That is exactly what I mean. We've had swing trades in these trades, a few 2 or 3 months. The goal now is to have them out in 1 to 2 weeks. That is the intention. Within 1 to 2 weeks, you should be out of the trade. 3 to 5 days is an ideal world. You don't want to get over the 1 month mark because you'll be core trading something. So you're on the lookout for long-term shift. This means you're putting larger stop losses on these stocks and you're trying to understand how to get bigger moves out of them, and you're attempting to diversify your portfolio and increase your wealth. Some of you may be thinking, what's the difference? The difference between intraday and swing trading is scalability. As a day trader, you have limits. As a swing trader, your limits are much, much higher. This holds true for whatever trade you make. Guys, whether it's a core trade, a swing trade, or an intraday trade, you'll need to look at a variety of time spans. A biased time frame should be used at all times. Then there's the entry time frame, which is the stock's direction. This applies to day trading, swing trading, and other types of trading. It makes no difference. You should always look at stocks in a multi-time frame view. This is to say, you should always be checking to achieve the largest picture possible. Use a time frame below your entry and a time frame above your entry. You get to move on to what if you pass the bias. The entry time frame is the lower time frame. This is known as the top-down approach. Start at the top and work your way down. Without this strategy, the minutiae would be doomed. Both day and swing trading are not a waste of time. If you don't do it, they'll become far less dependable. So, if your swing trade entrances are normally 60 minutes on daily charts, you should be looking at the weekly chart for your bias. Now, let's imagine your entrance is a 2-minute chart for a day trader. For your prejudice, you should be watching the 60-minute or the daily news. If you aren't already doing so, you're sabotaging yourself. And this holds true for all sorts of trade. What is the distinction between a swing trader and a day trader? So let's start with swing trading. Day trading is a much higher level. By much higher, I mean at least 10 or 20 to 1. In fact, I'm going to say 50 to 100 to 1. You don't have to sit at your desk all day. When it comes to evaluating a trade, you can take your time. One of the biggest problems that new traders face when intraday trading is that they don't have enough time to evaluate the trade, so they miss out. Because on a 2-minute chart, you can have 30 seconds, 10 seconds, or 1 minute to consider the trade. When swing trading, you have the entire day at your disposal. You have plenty of time to decide whether or not you want to take that trade. What makes it less significant? Because the parameters are considerably more expansive, consider this for a moment. A $0.30 stop loss could be used in an intraday transaction, so a nickel is quite significant, isn't it? On a $0.30 stop loss, a nickel is almost 20% and almost like 18% on a swing trade with a $3 or $4 stop loss. How valuable is a nickel? It isn't, so you can pay a little more. You can pay $0.20 and it isn't a big deal having some entry slippage. It's not a huge deal. So what's the bottom line? With your order entry skills, you don't need to be as precise or as good. Shakeouts are significantly less common and there are more. This is just a basic list. Do they take place? Shakeouts are less common and you have to see it all the time. High-frequency trading shakeouts, you get into a trade and then 10 seconds later you get shaken out even though you've had a $0.50 stoppage. It shakes you out, leaves a bottom, and then it goes back up. Hence, the 84% rule, but that's a different topic. So what are the drawbacks? There are some of the positives, not all of them, but some of them. What are the drawbacks? You're not making as many trades, therefore there's less frequency. Now for some people this is a positive, but many people this is a negative. But why? Well, you can't take as many trades, so theoretically you won't make as much money. We talked about scalability, so that should offset it. But you'll take fewer trades. It takes a lot longer to hit your target. You're not hitting a target in 22 minutes, you're hitting a target in 22 days. So we'll talk about time value of money later. Because it's being used for a longer amount of time, hitting targets takes longer. What's more, what's the big deal with that? Well, the longer it takes to reach a target, the more likely is it that something bad will happen, right? Let's be honest, if it takes 2 weeks to hit a target, that's 2 weeks of news, gaps, overnight risks, and markets doing crazy things. We've seen it before in where the president says something and the market soars. Oh, we just negotiated a new deal with China. The president says and the market soars. There's a market risk. You're short on trade. You had no idea that news was coming out and the market gap is up 400 points and you're short on a stock. That's going to hurt. So you have the overnight risk of news headlines or whatever else having a negative impact on the stock. Whether it's a tweet from the president or something else, there are merely news items that happens, and whether it be market related, whether it is the CEO of the company coming out or if the CEO is stepping down and so on, are tied to the stock in some way. This could have a negative impact, and now keep in mind that it could also be beneficial. Most investors could go into swing trading as it's more profitable. It also gives the investors more time to evaluate the market. And this brings us to the end of our video. I hope you enjoyed it. Hit like if you did, and don't forget to subscribe to our channel so that you don't miss any of our videos in the future.